Today I have yet another stock for you to put on your watch list as soon as possible. This channel is all about bringing you new stock ideas. Recent examples include Marqeta, a fintech company, ticker MQ, which is up about 25% since my video on them. Telehealth play TDoc, which is up about 8% since that video, a stock I want to put back on your radar, and microcap, re-commerce, precious metals, and IT recycling play, and Vela Corporation, ticker ELA, which is up about 5% and looks primed to make a move soon. And today's stock is high growth, subscription based, and it looks cheap relative to its peers. We've got comps tables, financials, and product reviews to get through, so make sure to subscribe if you like seeing new stocks and in-depth fact-based research. Let's do it. My name is Matthew, and I'm just going to tell you right off the bat which company we're looking at today, and that would be Bark, also known as Original Bark, known for the Bark Box. It trades under the ticker, you guessed it, Bark, B-A-R-K. And stop, I know what you're thinking. I don't want to invest in some dog food toy company, and also Matt needs a haircut. And while I do need a haircut, not investing in a dog food toy company could have cost you a lot of money, and it could be a huge mistake. Let me show you some proof. Freshpet, a pet food company, has 8x'd since its IPO almost exactly 7 years ago now. And Chewy, an online retailer of pet food, has almost 2x'd since its IPO in just 2.5 years ago. And we're going to compare Bark to Chewy, Freshpet, as well as Petco, and more once we get to the valuation section of this video, so stick around for that. Bark currently trades at the lowest EV to gross profit ratio of the bunch and has been downtrending for quite some time now, dropping 47% since its SPAC IPO. But could we have another 8x Freshpet on our hands? In this video, we'll be covering a business overview as well as catalysts for the business. Why are they down so much in this past year? The juicy financials for this business, their valuation and comps table that I referenced earlier, and finally, the risks involved in what I'll be doing with this stock. And by the way, this Saturday, October 30th at 1 p.m. Eastern is the first time ever that we have brought a live mentor session from investor community to the public completely for free. If you can't make it, you got to sign up anyways because we're going to record it and we'll send it to you. In this session, we're providing full analysis of one of the hottest stocks today, that is SoFi. I'm talking analysis so deep that you won't find it anywhere else with any other group of people. And in my YouTube videos like this one, I only get to talk at you, but in the live webinar, you get to be a part of the conversation and ask questions when Nick is going over his projections or as Kevin is charting out the stock, and of course joining in on our live Q&A at the end. So if you've ever wondered what are these live mentor sessions that Matt's always talking about, who are these mentors with these amazing track records, you need to sign up and see for yourself. Register, and I can't wait to see you on the call. All right, back to the video. Let's get into what Bark does. They describe themselves as a company of dog-obsessed people who serve dogs across 4 key categories: play, food, health, and home. More specifically, their monthly subscription boxes include Bark Box, which is one of their 2 core subscription services, delivering monthly themed boxes of dog toys and treats. The second core subscription box is Super Chewer for the apparently underserved larger dogs with particularly strong chompers. Newer offerings include Bark Home, which is beds, bowls, collars, etc., Bark Bright, a health and wellness offering with items such as dental kits, and finally, Bark Eats, one of the newest initiatives. It is a personalized monthly meal plan serving the premium dog food segment. As of December 2020, they had 1.7 million active subscriptions and 7 million customers. And don't be surprised if you see more of Bark's customers start subscribing to more than one of Bark's boxes, and that's thanks to Bark's Add a Box. Add to Box is Bark's cross-promotion initiative to get subscribers to add, say, Bark Bright to their existing Bark Box subscription, and eventually get fully immersed within the Bark ecosystem. Most recently, Add to Box revenue jumped significantly in Q3 of their fiscal year 2021, which I believe is our calendar year 2020. This business claims to be vertically integrated, which is almost always a positive. It seems like all of the toys and designs that they make are made uniquely for themselves. And they also describe themselves as data-driven, which honestly just sounds like a bit of a buzzword, but this slide right here almost makes it make sense. See, they have 1.1 million subscriptions shipped, and for those subscriptions, they're collecting data like breed, size, age, playstyles, activity levels, allergies of all these dogs, and this data allows them to generate 150,000 monthly customized assortments for their clients and their dogs. They're an omni-channel brand, which is just a fancy way to say that they're online and in brick and mortar. They're online direct to consumer, as well as partner with Amazon and partner with with brick and mortar places like Target, Petco, and Costco. Speaking of which, their reviews are actually quite strong across their products on Amazon. Their flagship Bark Box is 4 stars, which could be better, but many of their individual toys seem to have 4.5 stars or better, and this is the research you have to do with these kinds of companies. Furthermore, their Trustpilot of 4.8 far outpaces that of a competitor like Chewy.com. Moving back to their offerings, it looks like this company is betting big on Bark Eats, their personalized meal plan service. After all, the two companies that 8x'd and 2x'd, Freshpet and Chewy, were focused on being pet food providers, not necessarily providing things like doggy beds or doggy toys. The dog food market, interestingly enough, is growing at a 5% CAGR, or compound annual growth rate, reaching $24 billion in 2020. Now, although that's a big number, it honestly feels rather competitive and not too big. The evolution of Bark Eats will be big for Bark moving forward. It seems like a lot of their future growth does depend on this one subscription box, so keep an eye on how much cash they're burning for this service and if it's actually taking meaningful market share. Now the question is, why is this stock such a beaten down dog? I've been waiting all video to say that. Well, my guess would be it's because they went public via the SPAC route. They merged with North Star Acquisition Corp. And because of that, they were probably grouped with the rest of the SPACs that are having a terrible 2021. It's kind of like a throwing the baby out with the bathwater type of situation. Many SPACs, for example, got punished because in their presentations and their mergers, they gave BS projections and they were really just trying to sell themselves to investors. Of course, they fell short of those projections and SPACs in general were punished for it. However, Bark's guidance seems to have held up since their management presentation after the merger. This revenue projection from May of 2021, keep in mind their fiscal year is 1 year ahead of the calendar year. Their highlighted fiscal year 2023, $706 million in projected revenue, looks like it has held up or even gotten slightly more bullish in the last 5 months since that presentation. That's better than most SPAC IPOs can say for themselves. They also recently reaffirmed their $516 million revenue projection for fiscal year 2022, which is this year, in their most recent quarterly press release from August. So while they're still convincing us that their projections seem to be legit, that's a great segue into their juicy financials. We got to start with the balance sheet, which honestly looks pretty dang strong. They have $321 million in cash, which is enough to pay off all of their liabilities and still have $100 million in cash left over. The current ratio is well over 3 and just about $71 million in long-term debt on the balance sheet, which again should be easily serviceable with their cash on hand. Now moving on to their previous years of performance and their income statement, we can see year-over-year growth for revenue is kind of inconsistent, and we're not yet sure if this 64% spike in particular was a spike from lockdown or not. That said, they do have strong gross margins. The operating margin also seems to be improving because of the operating leverage of their business model. For example, their CAC, or customer acquisition cost, has dropped from 2020 to 2021 by 14.2%, and that is great to see. It means it costs them less money to acquire a new customer. It's even better than the reduction in CAC from 2019 to 2020 of a 4.7% drop. From a profitability standpoint, it looks like there's a path there, but adjusted EBITDA is also a trickier metric that can be kind of gamed by sneakier accounting. So I'd want to dig into the line items a bit more before believing entirely what I see here. Now, some more recent metrics from the Q2 report aren't quite as rosy. Churn rose 1.2% to 7.4 from 6.2. New subscriptions were still significant, but slightly slower. And lifetime value of the customer to customer acquisition cost, that ratio dropped from 9.5 to 5. On the bright side, the average order value did slightly increase. And now this brings us to the valuation and the comps table. All right, so this is actually a comps table that I sent to everyone in the investor community. So if you haven't already, check that out in the description below and join our free webinar at the end of the month. But this comps table compares Woof, which is Petco, Bark, the company we've been talking about all day, Chewy, CHWY, and Bochi Holdings, I think is how you pronounce it. They're from China, and Freshpet, FRPT. So this here is just market data. This is just their price, market cap, and total enterprise value. And I like enterprise value because it takes into account cash and debt. For example, if you look at Bark, their market cap is 1.12 billion. However, their enterprise value is 790 million because they have a lot more cash than they have debt. Then over here, we just have some financial metrics like their trailing 12 months sales, their gross profit for the past 12 months, EBITDA, earnings, revenue growth year over year, and projected next year's revenue growth as well. And keep in mind that this comps table is what I initially did first to figure out if this stock was worth looking into or not, and actually convinced me that it might be trading a little bit too cheap. So pay attention. So So we want to use the numbers that we just compiled to create the valuation ratios, and this is the stuff that's really most important. But first, let's set up the scene a bit. In terms of revenue growth year over year, BARK takes the cake by a mile. However, I put this in yellow because, again, as we saw before, the revenue growth is inconsistent. And also, projected for next year, they're expected to do 36% revenue growth, which is basically cutting their past revenue growth year over year in half. Now, yeah, this is really high growth, but that big drop is not ideal. So that's why I made it yellow. But everything else in green, these are good things for BARK on this table. For example, looking at EV to sales, they are trading as the third cheapest option of these competitors, the cheapest being Bochi Holdings, which is a Chinese company, so it's most likely going to trade cheaper. It's also a very, very small cap company, so it's probably why it's trading at a discount. But next cheapest is Petco, and then not far behind it in terms of EV to sales is BARK. And compared to Freshpet and Chewy, their actual main competitors in terms of growth rate, because Petco's growing at just 5.8% next year, you can see that BARK looks rather undervalued compared to the two that are growing at the same pace. Now, in terms of gross profit, original BARK is actually the cheapest in terms of EV to gross profit, but I'll touch on this more later in the risk section. Lastly, to finish this up, we don't have any profitability ratios for BARK because, again, it is not profitable. And in case you were thinking of looking into Chewy, they just became profitable, which is why their profitability ratios are so high. But yeah, to wrap this up, looking at EV to sales and EV to gross profit, BARK actually looks pretty cheap compared to its peers, especially when you consider that it's a subscription business, which has recurring, predictable, and highly visible revenue and financials, but it also is growing at a relatively fast clip, kind of leading the pack. All right, so now it's time to talk about the risks, which we must talk about, and what I'm probably going to be doing next in regards to this stock. First is right off the bat, their presentation did have a lot of buzzwords. I didn't show you all of them, but it almost felt like gimmicky at points, and that just gives you a bad feeling as an investor. You feel like you're trying to be sold. Maybe this is more of a personal opinion, but I felt like it was worth noting. But to get back on the facts track, they've only been public for one quarter. They've only published one quarterly report as a public company. I'd like to see them publish some more, obviously, so I can get a better feel for management, better feel for what they have cooking in the kitchen, and a better feel for what their numbers are going to look like moving forward. Also, this one's a bit more nuanced, but general and administrative expenses, I would like some more visibility into those, and I'd like them to break it out because there was some talk about potentially their gross margins being artificially high because they're hiding a lot of expenses in G&A and moving expenses that should be in cost of goods sold over to G&A. So I'd like to see them break that down in future quarters as well. And the last three risks I want to touch on is one, a highly competitive market as we saw. Two, it seems like a lot is riding on BARK Eats right now. So again, I'd like to see a couple more quarters of execution to make sure that is going well. And finally, third, they're unprofitable. Ideally, right now, I would find profitable companies, but I'm willing to purchase companies that are trading cheaply compared to their peers, have a path to profitability, and have good, solid, high growth, which this might fit the bill on, but I'm going to stay a little bit more patient here. So those risks pretty much describe exactly what I'll be doing as well, waiting a couple more quarters to see if those questions I just posed can be answered. So for me, it's a watch right now. But that's the point of this channel. It's not only find new stocks I want to buy, but also share the ones that are worth watching, the ones that at least have a reason for you to dig into them further. I want to help you get started on your research, so make sure to subscribe if you enjoy this video and toss a like if you enjoyed it as well, because they do take a really long time. If you want a full in-depth analysis of technicals and fundamentals of SoFi, check out the link below. Make sure to register. I will see you there, and subscribe.